Going everyone, I hope you're all having a great President's Day. And in this video, I'm going to be going over my outlook or my forecast for the markets through the March OPEX cycle and heading into April as well a little bit. Okay, so for those of you that don't know, new cycles begin with a new OPEX cycle, and then old trends or old cycles in the market end or die essentially at the conclusion of an OPEX cycle. And so Friday, February 16th, was the conclusion of February's OPEX cycle. So now, starting on Tuesday, we're going to be beginning March's OPEX cycle. Okay, and that will run through March 15th, I believe it is. All right, so to start this video off, I see only two high probability paths that SPX and equities in general will follow essentially through this March OPEX cycle. Okay. The first path is a months-long consolidation period. Okay. And it's going to be very choppy, very sideways balancing action as the market essentially builds momentum through a whole month to take that next leg higher in this raging bull market. Okay. So that is path number one. And I have that outlined in black here, and I'm going to go over more detail in a minute. The second path that I see the market taking is a correction is going to begin very, very soon. If it hasn't already begun already, following the all-time high at 50.48 for SPX. Okay, this correction, if this is what we're going to get, it's going to break away from seasonality a little bit. Typically, March is a sideways month in general, but April is a bullish month. So if we're going to enter a correction, the market's going to be correcting through April as well. Okay, I don't think this correction can be completed in 1 month. I think it's going to have to leak into April a little bit, and then that'll set up a strong rebound through summer and into early fall when we will see new all-time highs eventually. Okay, so the two paths for SPX is a months-long consolidation period, which I have drawn right here in this black box. Okay, and let me make sure this chart is fixed. All right, there we go. So this is essentially going to be the range that I see the market entering. Okay, and yes, February was a strong OPEX cycle. We can see February's OPEX right here. Okay, this was the range or for February's OPEX. I think the range for this for this path for the market to choose has already been established. And by that I mean is 50/50 SPX and 4,900 will be the floor and the ceiling of this range. Okay, so I expect 4,900. I expect all dips into 4,900 to be bought if this is the scenario that we see play out. Yes, there will be traps in this scenario. There will be false breakdowns below 4,900 to trap breakdown traders. Okay, people who trade breakouts or breakdowns, they wait for those key closes below. Okay, well, you might have already missed the move if that's the case. And the pain trade is to give them their close that they need to see see that hypothetical breakdown, only to reverse it overnight for a possible gap up. Okay, so be mindful if we are going to see a balancing March OPEX cycle. What that means is we're going to see some false breakdowns below 4,900 most likely. At the same time, we're going to see false breakouts above 50/50. Okay, you're going to see a lot of breakout traders. On the flip side, if you're a bear, obviously a breakdown below 4,900 is your key. That's the key setup you want to see to enter a big short position. Okay, the pain trade for bears is to snap that back up and back into this range. Okay, on the flip side for bulls, the pain trade comes with a breakout over 50/50, only for it to fail and fall back into that range. Okay, so this March OPEX cycle, if this is the path that we're going to see play out, it's going to be painful for a lot of people, and a lot of people are going to be trapped on the wrong side of a consolidation period. Okay, and this is not the first time that we have seen a months-long consolidation period. We saw a prolonged period of consolidation in December. Okay, this was essentially 2 weeks of consolidation. Okay, and we also saw it back in May of 2023. Okay, May was a very choppy month. A lot of people got chopped up in May, if I remember that very well. But of course, a months-long consolidation period can accomplish the same thing that a correction does to some degree. They are different. I do want to stress that. But they can accomplish the same thing. Okay? That being that the market can rally following a prolonged consolidation period for a month or more, and it makes that rally healthy because it resets oscillators and it resets these overbought conditions that are currently in the market. Okay, and I think it's really easy to say that the market is oversold a little bit. Daily RSI is at 62, but if we break it out to weekly or monthly, we're definitely talking about overbought levels. Okay, with that being said, if we see this months-long consolidation period, I'm eyeing a breakout of this range to the upside at the end of March's OPEX cycle, and that sets up a very bullish April OPEX, targeting at a minimum 5,200 SPX. Okay, I want to make that very clear. If we get this months-long consolidation, that is very, very healthy action. It means price is accepting itself at higher prices, essentially, or traders are accepting higher prices, and the market is building momentum to take that next leg higher. 5,200 is an easy long target heading into April OPEX under this consolidation path. Honestly, we could see 5,300, 5,350. I would not rule that out into April OPEX, but that only happens if we get this months-long consolidation period. And I think it's really important for buyers to hold 4,900 under this scenario. Okay, the correction path that equities and SPX can take is we're going to see an ABC corrective wave pattern play out. So I'm using all-time high currently as the beginning of wave A. I do not rule out a new all-time high before we see this corrective wave pattern play out. In fact, that would be Wyckoff's distribution model playing out to perfection, with this being the buying climax right here, followed by a new all-time high would be what we call the failed rally, and then the markdown phase begins from there. Okay, so do not rule out a new all-time high to put in place that failed rally, which means price falls back under 50-50, and then wave A begins. All right, so do not rule out a new all-time high. If we're going to see the corrective wave path through March and April OPEX, weakness needs to hit the market this week. The window of weakness is open. Okay, after the conclusion of February's OPEX cycle, I really want to stress that the window of weakness is now open. There was not going to be a market sell-off through February. Once they were able to smash through 4,800, they were going to push it over 5,000 SPX, and have had this 50-50 target marked for a month in my Discord server. All my members have known about it. We're so far 2 points off of it. So I consider that achieved. And now the window of weakness, now that February's OPEX cycle is over, the window of weakness is now open. And I really think buyer or sellers got to get in control this week to put themselves back in control of the trend. So we're going to see wave A. I think a really easy wave A target is price returning to 4,800. Okay, it's going to provide a bounce because it's old resistance, and that is going to turn into new support. That bounce off of 4,800 is going to be wave B. This rally will be shorted. I'm not sure where wave B ends. I'm eyeing either the 50% or the golden fib level as two possible rejection points. I also like wave B ending at 4,900 when it comes. We can see this level is a bit of a key level so far. So far, it is 2024's point of control, but that is obviously open to change depending or as the year continues. But with that being said, if there ends up being a key fib level around 4,900, I feel like that is where we will see wave B come to a conclusion. And then wave C is going to last into the end of March OPEX and most likely into April OPEX as well. And that's going to return, or that means price is going to return to the value area high, or VAH, of 2023's profile at 45.50, around that area. I have 45.55 marked, 45.50, that's also a good level. You can see this level marked right here. That puts price back into a very key previous accumulation zone. This accumulation zone prior to December FOMC that resulted in this breakout rally that we've been in ever since, essentially, buyers want to defend this level. And lo and behold, assuming we don't see a new all-time high, and assuming 50.48 is the beginning of wave A, from 50.48 down to 2023's VAH, that completes a 10% correction for equity, or for SPX, which is a very, very healthy correction, and it sets up SPX to have a very strong second half of 2024, in my opinion. And we can then see 5,500, 5,600 trade into the end of the year if we complete this 10% correction. Okay. That is my ideal path, or these are my two ideal paths and scenarios for SPX for March OPEX. I do not think SPX can keep bidding up every other day, trending higher through March OPEX. I don't think it's a sustainable path, but it's always a possibility, right? So it's not my base case, but I'm not going to sit here and say it's a certainty that doesn't happen, because that would be negligent on my part, okay? Anything's always possible. That is just not my base case, and I don't think that is the high probability path. So to reiterate, the two high probability paths I have for March OPEX is a prolonged consolidation phase, and we will see a breakout of this range towards the end of the March OPEX cycle, which sets up a bullish April, or we're going to see a correction begin through this OPEX cycle, and we're going to see that weakness last into the month of April, and we're going to at least print 45.55, 4,500 SPX, complete the 10% correction, and then we will enter a new reaccumulation phase as buyers add back into their long positions and gear up for the next leg higher of this bull market. Okay, I want to be crystal clear here. I'm not calling for an all-time high top for the whole decade of SPX or for the S&P 500. Okay, that is not at all what I'm talking about. But bull markets remain healthy with corrections. That's something we didn't really see a whole lot through 2020 after the COVID bottom and through 2021. That's why the 2022 bear market resulted in 3,500 trading, a 1,500 point sell-off essentially in S&P 500. If this market completes a correction, that is a very, very healthy longer term into the rest of the year as far as I'm concerned. And it is going to pay huge dividends to maintain a bull through the rest of the year if we get this correction to play out. So how do you trade each of these as far as a day trader goes? Okay, if you're a day trader and we see this consolidation path play out, you're going to want to size down. You're going to take those base hits as they come, and you're going to want to not be greedy. You're not going to want to be aggressive, because that's not going to pay off for you well. If we're going to see the consolidation phase, the consolidation path, the market is going to trap a lot of people. A lot of people are going to get burned. There's going to be bouts of volatility on the intraday timeframes. Of course, if you zoom out, the market will be range bound. That still doesn't mean people won't get pinched during the cash sessions as they come. Okay, on the correction path, you're going to see a change in sentiment. You're going to start seeing lower highs and lower lows. You're going to see rallies being sold off into fresh lows. You're going to see that change in sentiment, and it's going to become pretty obvious very quickly. You can use that to your advantage, especially as a swing trader. Position yourself short on low volume rallies, whether it's a day-to-day basis or a multi-day low volume rally. Once you get that hint of weakness coming in, you can scale into that quote-unquote strength that's on low volume, so it's not a high probability path, and then you position yourself short with time, eyeing that rally being a lower high, and then, of course, you're positioned short, anticipating the lower low to come from a swing point of view. Okay, exploring core short positions with March monthly contracts, that is going to be the ideal path here. And one more thing, the market has to pin it. There has to be, and I'm going to use quotations here, the market has to pin a correction on a catalyst, because there has to be a reason why the markets go down. The markets are built to go up after all. There are three things that I can see happening over the next month or two that can be a catalyst for the markets to go down. Fears of more bank failures, NVIDIA and chips reversing to the downside, or the dollar and yields rallying higher, and of course they will act as headwinds for equities. So if either of those three things start to pick up steam, and you start hearing about big accounts on FinTwit, or people in finance media start talking about that stuff, that can be the quote-unquote catalyst for the correction, and that'll be the reason, again, quotes around that, the reason why the market corrects itself. All right? But I hope you enjoyed this video. If you have any questions, feel free to drop them in the comments below, and I will be more than happy to answer. And if you're interested in joining my team, the link to my Discord server will also be in the description of this video. Take care and have a great month of trading.